Hi, this is Keith Singer of Singer Wealth. A lot of people are concerned about the stock market. And when you have to plan for the future, you have to assume a return, right, for your investments so that you know how much money that you need to save for retirement, how much money you're going to have available to you once you're in retirement. And a lot of investors who invest in stocks assume that stocks will earn 8 to 10% because that's what they've historically earned over the last 70, 80 years. But the reality is a lot of investors aren't investing for the next 70 or 80 years. They're investing for the next 10, 20, or 30 years. And I would submit that if you're in or near retirement, the next 10 years is the most critical to the success of your overall planning, because if we have a really good 10 years, you'll probably be really well off. And if we have a really bad 10 years, you might not be able to live the lifestyle you were hoping without cutting back and potentially having to reduce your lifestyle. And so let me show you what I mean. I'm going to share my screen with you, and let me give me a sec. We're going to, all right, so here we are. So we go to, this is a graph of the stock market adjusted for returns after inflation. Because when you invest in stocks, it's all about how much, not only how much it grows, but how much it grows relative to how much inflation was, right? We're trying to beat inflation. So between 1921 and 1929, the S&P 500 returned 400% after inflation. It did almost the same thing again between 1949 and 1966. 1986 to 2000 was an amazing bull market, 670% return on your money after inflation. Imagine how much you must have liked being a stock investor back then. And then 2009 to 2021, you made 300% on your money coming out of the financial crisis. That's after inflation, obviously. Now, the bad news is that sometimes stocks do really bad for an extended period of time. Between 1900 and 1921, you would have lost 70% of your money after inflation. Between 1929 and 1949, you would have lost another 70% of your money after inflation. And that's typically when investors tend to not want to invest in stocks after long periods of down underperformance. Between 1966 and 1982, you would have lost 60% of your money after inflation. And between 2000 and 2008, 40% after inflation. So what is the moral of the story is that over the next 10 years, anything could happen, right? You could be down a lot or you could be up a lot. And the last 12 years was really good. And typically bad decades follow good decades and vice versa. So the question is, if you're in or near retirement, how would a prolonged bad stock market, like we've had several times in our history, affect your ability to live the way you want to live for the rest of your life? Okay. Would it negatively affect you? And for a lot of people, the answer is a resounding yes. And so if that's the case, we can't rely on just stocks to help us achieve our financial goals. And what we've seen recently, we can't always rely on bonds either, because bonds can go down as well. So there are plenty of alternative investments that can do well, even if the stock market isn't doing well. And as a firm, our firm Singer Wealth really specializes in making sure our clients have a lot of exposure to alternative investments like private equity, like private credit, private real estate, private mortgages, and structured notes. And so all of these things that I just mentioned can do well, can yield 7, 8, 9%, even if the stock market's down 10 or 20% that year. And so if you're interested in learning how to add more alternatives to your portfolio, call us at 866-WEALTHY or email me, Keith@singerwealth.com. Thank you for listening, and we'll talk to you soon.